Hi there, my name is David and you're watching Critical Trading. You've most likely heard of an indicator called ATR. It's one of the most popular indicators out there and I use it myself in pretty much all my algorithmic trading systems that I run in the US stock markets. There are quite a few different ways you can use this indicator to improve your existing trading strategy, develop an entirely new one, or manage risk. In this video series, I'm going to show you different ways on how to use this indicator in practice. This is the first episode of this series, so make sure to watch the others as well. I'll put a link in this video's description for you. In this particular episode, I'm going to show you how to use the ATR as a tool to calculate mean reversion entry prices. Now, if you don't know what mean reversion is, have a look at my video I made a while ago that explains it, link in the description. By introducing a simple calculation involving ATR, I was able to slash the drawdown of my existing mean reversion strategy from 51% to 13%. So let's get right into it. The original version of this mean reversion stock system generated a valid buy setup on this day, the one I've just highlighted with the vertical marker. Now, don't worry about the setup rules just now. I'll share them with you in just a second. In its original form, this system would then process a buy market order to enter this stock at open of the following day. This is a very common execution when trading on daily timeframes. Entry would have been made here, and the corresponding exit would have been made here, again executed at open. Now, in case of mean reversion strategies like this one, this kind of entry and exit execution is most likely not ideal and would likely result in not so great performance, despite it would have worked on this particular trade. One idea to improve the entries is to try opening our positions below the current price, essentially trying to get a discount at the entry. I plotted the ATR indicator with period of 5 below my chart. It shows us the average price range of this stock over the past 5 days, which gives us an indication as to how volatile this particular stock is. So how exactly do we use this indicator as a limit entry tool? It's very simple. Instead of just entering when the market opens at whatever the price it opens, we use ATR to measure the stock's volatility and place a buy limit order below the current price using that fraction of the stock's volatility. In our case, our limit order would have been placed somewhere here. By employing the ATR, the distance of our limit orders from the current price is dynamic. It takes the fact that stocks vary in their volatility into the account. For example, looking at this list of stocks, we can see that the stock right at the top of the list is more volatile than, for example, the other ones to the bottom of this list. Because our limit orders are calculated based on these readings, they are more in tune with the market as opposed to using static numbers such as placing the limit order 1% below its current below the stock's current closing price, for instance. Now, moving on to the rules of this strategy. This code comes from AmiBroker, which is the software that I use for my own trading. I'm going to go through these rules very briefly. Strategy looks for stocks that declined more than 2% on the previous day. The higher the decline is, the higher the stock ranks. We're therefore looking for the most oversold stocks on a daily basis. There are a couple of more rules visible on my screen, but let's jump straight to the limit price calculation. We're using the closing price as a basis for the calculation, and also the ATR with period of 5. So the ATR is based on the past 5 trading days. When there's a valid buy setup generated, we simply take the current ATR's reading and we take 3/4 of it and subtract this from the closing price of the stock, and that equals our limit buy order. It's as simple as that. Moving on to the results. Orange equity curve is the original version of this system that enters at open, whereas the green equity curve is the version that uses ATR indicator to calculate the entry price below the current price. In this particular case, just looking at the equity curves doesn't really do the justice. Let me show you the underwater curves instead. These show a massive improvement. These are the curves of open drawdown, i.e. an open loss of each system's variation at any given time. While the version that uses limit orders based on ATR has recorded a maximum drawdown of about 13%, the original version's figure is just above 50%. Now, this is a huge improvement, and the orange version of this system is simply not viable to trade in the real markets. Here are the backtest results. Despite the version with limit orders recorded a slightly lower average annual return, its maximum drawdown went down significantly, as well as number of trades. This makes this version a much better candidate. Now, please don't be fooled by the fact that this system generated only about 9% average annual returns. This figure on its own has very little meaning because this system's drawdown is at acceptable 13.59%. We could simply start trading it on margin, increasing the profitability. We could not do that with the original version of the system, as we would have lost our entire capital when trading it on margin. Here's what I mean. The purple equity curve is the version that trades on margin. The performance has got more interesting. The average annual return is at 17% now, making it a great starter mean reversion strategy based on the ATR. Thank you for watching. See you in the next video.